Hello, this is Eric Boyce, President, CEO, and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for February 19th of 2023. Please see our disclaimers for important information. Well, I thought I'd start off this week with a chart from BlackRock, which does a really wonderful job of kind of giving us a perspective of not only diversification, but also the time value of money and the fact that if you give yourself a long enough investment horizon considering the year that we just exited, that it does mitigate over time. And so, what you have here is, looking at different periods. Take, for example, the first line, and in these columns, you have the S&P 500 return for that particular period, as well as a return of kind of a representative portfolio. See there, it has large cap, mid cap, small cap. It's got a lot of different things in it, but by BlackRock's definition, it's a diversified portfolio. And just taking, for example, that first line, 2000 to 2002, that was the tech bubble bursting. The S&P 500 during that period was down 40.1%. And a diversified portfolio was down a lot less than that, but it was still negative almost 16%. You can see 2003 to 2007, it was an up year. 2008, we all know, was the global financial crisis. That was a bad year. And then you had a very long uptrend in the market preceding the pandemic there in the first quarter of 2020. And so you have these different periods of time where, over long horizons, they tend to be up, although you have these episodic things like the pandemic where markets are down in a pretty big way and it feels bad. And so the emotions are captured on the right side of this chart where it says, in 2000, 2002, you lost money. It felt bad. It was visceral. It was painful. And then 2003 to 2007, diversification worked and you felt good and there was positive emotions, but that's what you'd expect the markets to do over time, right? And then 2008, it was down a lot. And then I lost money, again, negative feeling. And then, so back and forth. But over time, down at the bottom, the highlighted area where it says total return, and this is over a 20-year period, the markets were up on balance. The S&P itself was up 288.6% in the aggregate. And if you had $100,000 invested at that point, you'd have $388,000, $610. 388 and $610. But diversified portfolio would have actually been up a little bit more than that. And you've had just over 400,000. So even when you have periods like last year, which without a doubt was a historic year in terms of the negativity in the markets, both on the fixed income and the equity side, that despite that the long-term power of diversification is very, very much intact. And so this chart is just wonderful. When I saw it, I said, I absolutely have to lead with this chart. Again, as we exit the bad year, we're in a positive year thus far. We've got some more charts that, talk about, well, we have another chart later on in the pack that talks about what happens to the equity and the bond markets typically after you have the last interest rate increase. And so, we'll talk about that, but this one's really powerful in what it tells you about the virtues of long-term investing and being diligent with your diversification strategy. Now we'll get into some of the economic data. So we had both the consumer price index release as well as the producer price index release. And these are notable for a lot of different things. And obviously it's kind of had an impact on the markets. It's had an impact on our expectations for the terminal rate of rate increases in this particular cycle. But here in the consumer price index, you can see in these bars kind of moving from left to right, the January monthly number was up 0.5%, and that was up versus, and that was a January reading, and so December was up only 0.1%. You can see, how that plays out on the right-hand side of this. But on a year-over-year basis, it's up 6.4%, and that is for January, and that's versus 6.5% December. So it represents the 7th straight month of an annual rate of inflation going down. That's a good thing. Now, and the peak in inflation was on an annual basis was 9.1% last June, which itself was the highest since 1981. So we have this continued deceleration in CPI, and but I think the takeaway from this is that it seemed the pace of the pace of this deceleration seems to be slowing a little bit. So, naturally you hit the pause button in sentiment right here and you say, well, all right, well, what does that mean? What are the implications for interest rates? So on and so forth. What are the implications for the investment markets? But, again, I want to focus on the trend, and that trend is clearly down. Here's a 12-month change. And so, like I said in the prior slide, the overall 12-month change in the CPI is 6.4. Core rate is up 5.6%. You can clearly see that that's above the trend line. You can also clearly see that that's above the Fed's 2% kind of target, even though the Fed really looks more at PCE or personal consumption expenditures. But here you can see, where things are definitely rolling over. But if you believe that the pace of that deceleration is beginning to slow, then all that does, in my mind, is kind of reinforce this notion that we're going to have for the balance of 2023, an inflation that's probably a bit more than twice what the Fed target is, and then we're just going to be living with higher inflation for a period of time. And so the pundits that that are becoming fewer in number that feel like we're going to get down to 2.75 by the end of this year, I think are off the mark. And honestly, I think an inflation figure, at least core inflation of around 4%, makes a whole lot of sense by the end of this year. Contributions to inflation here, we can see how that's evolved. And this is the all-in inflation number. So remember that number on an annual basis was 6.4% here. And so you look at what the components are, and obviously food and energy are quite volatile. Energy has come down quite a bit, we know that. Food, importantly, even though recently we talked about egg prices and some of these other component prices that are just extraordinarily high, but for reasons, for kind of like exogenous, one-off type reasons. But food is rolling over. We can see that here in those gray bars and the contribution to CPI. Energy down, we see shelter kind of holding in. We do have a chart here coming up with rents and showing how rents are playing out right now. And so, outside of food and energy, things are kind of holding in there, maybe kind of wearing down a little bit. Shelter, again, if we talk about rents, shelter we know is apt to come down a little bit more, and then other core services that are influenced by wages, those things might be a little bit sticky, and I think that's, again, reinforcing this notion that we're going to have higher than trend inflation for this year. However, I do think, if it's expected and it normalizes, I think the market can very well handle that. Now we'll look at the implied Fed funds rate after this data came out. And so what you just saw was the consumer price index information. And now we will have the producer price index coming after this slide here. And you can see here that the expectations have moved up a little bit. So, whereas they were kind of hugging around 5%, now it's looking more like 5.25%. But honestly, this is where I've been kind of anchored in my own thinking. And I do think this is ebbing towards the consensus amongst Wall Street analysts. Now, this is just the implied rate that the market is determining as a whole. And again, it's not a shock. I don't fear the 5.25% rate. I think it makes a lot of sense. That implies another couple of rate increases beyond one that we're expecting not too long from now. So again, those rate increases for the peak interest rate in this cycle now expected to be closer to 5.25. Now we'll look at producer prices, and you could see in this number, again, on a monthly basis, we had 0.7% in January, and that is versus 0.2% in December. And again, 0.7% in January versus 0.2% in December. And so on an annual rate, that's 6% versus 6.5% in December. So when you look at these things, obviously it looks like, we had a spike, and obviously it caught the market unawares. And so, we do know, again, the trend line seems to be mitigating a little bit, but it's still relatively high. And so we know that we haven't exited this period of outsized inflation just yet. So as we look at personal consumption within the PPI index, so you can see here that we had a little bit of a slight reversal around kind of a flattening plateau, if you will, but it's not a big surge really. And then the annualized percentage rate of change is about 1.4%, so fairly benign. So this is on finished consumer goods. Again, it's not symptomatic of like a hyperinflation type scenario or something that's like re-accelerating necessarily. So now we're looking at PPI materials and components within the manufacturing side of this. And you can see here that we've had 8 consecutive months of decline. And although we, clearly, down 0.1% here for the pricing in this particular sleeve, that is certainly less severe than we've seen in prior months. You can see how, on a cyclical basis, this does go up and down in bunches, in batches, I should say. But if you look at, what we see up here in the blue line, which is more the aggregate index, and you see that coming down a little bit, even though it's still elevated, as we've talked about with a lot of these indicators that are on inflation that are still elevated, but they are moving in the right direction. I think it's just going to take some time, and we have to exercise some patience here. So now we talk about services, and this is services inflation. So we're off our peak. The 3-month annual or 3-month annualized growth rate is about 4.8%, and so that is the fastest rate that we've seen since May of last year. So and this encompasses wages, it encompasses compensation to a large degree, which we know the labor component of services is extraordinarily high. And so this is meaningful, and I think wage inflation is going to be with us for some time. We do see average hourly earnings begin to temper a little bit, but overall wages are going to remain high, and this will be the item, the component of inflation that makes overall inflation continue to be a little sticky, I think, into 2024. Well, here's our Conference Board index of leading economic indicators, and you can see here that we were negative in those indicators for the month. You can see the trend line has been negative for some time. Those red shaded areas represent recessionary periods, and so, but you do have on occasion negative readings in the LEI. You can see there, and sometimes you have 2 or 3 in a row, but it's those are oftentimes kind of false negatives. Well, what we've had here is 8 or 9 months in a row of these negative indicators, and so if you're looking at it objectively, it would tend to, in your mind, kind of reinforce the notion of this pending recession. But as we'll see here in some of these slides additionally in the chart pack, that like retail sales and labor markets are still strong. These are things that you just don't see if you're like on that doorstep. So now if we look at the 6-month annual change in the LEI, this has, I think, more explanatory power. And so the data series here goes back to 1960, so it encompasses quite a few more recessions. And you can see the cyclicality of this. But when you have those meaningful negative dips in the 6-month annual change number, that lays fairly close on top of recessions. Now, back in the early 60s, you didn't have that, but you still had a recession. But in really every other case following the mid 1960s, when you had a dip in the LEI of this magnitude on a 6-month rolling change basis, that you were in recession. So again, puts and takes here. But this is the LEI that, I think it does have some pretty good predictive power here. So again, the question is now, if it is a recession, and we've got some statistics that are kind of, analysts are predicting inflation, but then you've got Goldman Sachs on the other hand that says that there's only a 25% chance of a recession this year. So a really mixed bag of opinion, but this is the data that kind of seems to suggest, okay, yes, that is on the doorstep. So as I just mentioned, here is a kind of a survey, if you will. It's a composite of a lot of different analysts. On the left-hand side, you got the Philly Fed Reserve, the Federal Reserve Bank of Philadelphia, and their survey. And so you can see here, professional forecasters, probability of decline over 4 quarters of GDP. You can see that that's gone up, and you can see on the right-hand side through a Bloomberg survey that that as you've gone from June into the current year, that's remained relatively high. And so even though the probability, if you will, or the number of forecasters and that are predicting recession and the odds of recession over the next 12 months is about 65 to 70. And even though that has come down slightly from the December survey, it's still pretty high, particularly relative to last fall. Well, with all puts, there are takes as well. And so, again, some of these things that seem to belie, what we just talked about, show up from time to time. And here's one too. So over the last, 3 months of last year, we had negative surprises on the economic front. Again, kind of reinforcing the notion of pending recession. That's why we saw in that last chart, the December probability of recession was a little bit higher. Well, we've had more positive economic surprises you see here, even dating back to, basically about, call it, 9, 10 months ago, when we had a fairly dramatic drop in this reading heading into June. Of course, we know June was a terrible month in the market, but economic surprises picking up oddly enough. And so, we'll have to watch this, but obviously not something you'd expect to see again if you're on recession's doorstep. And here's something else to take stock of. Retail food and service sales change from the prior month, up almost 3%. You can see that trend line has been relatively benign. And so, again, if you're really in an economic slowdown, of course, this is not something that the Fed necessarily wants to see, nor do they want to advertise it and that much. But it tends to reinforce this notion that we're going to get maybe 1 or 2 more extra rate increases to kind of slow this rate down, because this represents very much discretionary consumption here. Food, service sales. So these are like dining in restaurants. This is retail spending. So this is discretionary spending that is spiking right here, and so it would seem to reinforce that you have an economy that has some fairly strong underlying elements to it. So if we break that down on the retail sales front and we look at the components of it, just as I mentioned in that last slide, dining out, very much a discretionary item. If you're in an economic slowdown, this is the first thing that gets chopped normally. But you see autos, parts, auto sales picking back up, furniture sales over the trend line, electronics and appliances, again, another discretionary item. General merchandise is kind of a catch-all for everything else, but you can still see a lot of underlying strength in the retail sales side. And when you think about the overall economy, consumption represents about 2/3 to 70% of the economy, and retail sales accounts for a really big chunk of that. Well, and something else that I thought was really interesting and odd at the same time, you talk about gaming revenues, and this is like revenues bets made in casinos. It doesn't capture the Indian reservations, but coming from the American Gaming Association, again, if you're in an economic slowdown that's broad-based, you actually see a decline in this. And you actually did see in 2008, 2009, a deceleration in this trend. But obviously in 2020, you had, venues were shut down for a while, and so you had that very understandable dip there. But it's really picked up since then. Again, not something consistent with an economic slowdown. Gross domestic product. Now, as we're talking about economic growth, and I've said, over the last few months that I think, the first quarter, when we're all said and done with this, may be the strongest quarter that we have all year. And I still stand by that. I think we are going to see the deceleration, even though in some areas we clearly don't see it yet. But you can see here the trend line, the Atlanta Fed and their GDP now estimate, which has actually been pretty accurate relative to the other indicators out there. And, is now projecting about 2.5%, 2.5% gain in economic growth. And so you see that would layer on top of a couple of quarters prior to that, where we had reasonable economic growth. Even though it may be slowing down a little bit, but that comes off of the two negative quarters there in the first quarter of 22, which we don't have any indication at this point that represented a recession then. But again, economic growth is still expected to be positive. So if that's the case, then a recession is, by this indicator, by this kind of like jurisdiction, if you will, it certainly wouldn't suggest that a recession is like coming around tomorrow. So if we look at the Bureau of Economic Analysis, and KPMG does some work here on this as well, and so you can see where the January forecast has maybe been uplifted a little bit. We know the International Monetary Fund in their global economic estimate has actually raised estimates a little bit. So a little bit more optimistic here. And so you see January, as it kind of tracks into the later quarters of this year, you can see that GDP is expected to be negative for a few quarters and then turn back up later on this year and be positive into 2024. And so herein lies the quandary of a lot of estimators out there thinking, well, maybe the second half is going to be weak in 2023, and I think that's a viable scenario. But as we've shown you in charts of the week here over the last month or so, that the market tends to observe or estimate or predict the end of that, not only the end of the tightening cycle once it's apparent, but when you have visibility towards the next economic cycle, that you could still be in that economic downturn and stocks will rotate and turn positive at that point. And that may very well be the case here, because you see that if you get into as you get into the latter half of next year, 2024, that you're still very much looking at positive uptrends in economic growth. So here we have disposable personal income. Again, this comes on the heels of the retail sales data change from the prior quarter, and this is inflation adjusted, so it does factor in this outsized inflation we've got, and it's positive. Again, this represents kind of the underpinnings of some economic stability here in our domestic market, even though the investment markets are still in a bit of a quandary. And so if you have these kinds of readings at a point where after a year's worth of rate increases that you'd expect this stuff to slow down, this is actually pretty positive here, even though it might fuel the Fed to go a little bit further. Again, 5.25 from where we are now is not a huge stretch. But if that's the terminal rate in this cycle is 5.25, and you've got personal income readings that are like this, driven by higher wages, higher compensation, so on and so forth, then you're in pretty good shape overall heading into 2024. Here's an interesting chart as it pertains to the equity markets. And so this is the earnings yield of the S&P 500. So this would be earnings divided by price, which would be the opposite of the price to earnings multiple, which we know is about 18 times right now. And so, and that subtracts out the 10-year Treasury yield, which we know has come up, but it remains stubbornly low and certainly below shorter term rates. But as we see here, that the differential there is as low as it's been since, essentially 2010 here. And so, what that means is that bonds on a relative basis, on a yield basis, are a bit more attractive now than equities. And so, kind of exiting the economic realm and kind of re-entering the investment realm right now, I think, at 18 times earnings, when you talk about the stock market, it's a little tough to fathom, how stocks can really rocket higher from here. And maybe they trade in a range, perhaps. I think that's a viable outcome over the next probably 6 months. But stocks aren't cheap; they're not expensive. Bonds here are relatively more valuable because of that yield component. And I do think bonds have a decent shot in 2023 of actually outperforming stocks. Well, here's a Bloomberg chart that I foreshadowed when looking at that first one, and it says what happens to stock and bond returns after you have the last interest rate hike. And again, if you assume that last interest rate hike is maybe May or at the very latest, like in the early part of the summer at that meeting, what happens to these asset class returns after that? And you can see here, going back to 1994, that the data says that the returns are going to be demonstrably positive. And you can see in that table over on the right, in those periods where we did have some difficulty in the market, but after you got to that peak interest rate, in the rate heightening or tightening cycle, if you will, that you have better performance out of stocks and bonds, and so we have that going for us. So when you look at the S&P 500 and you talk about volatility and kind of it just feels like volatility has kind of died down a little bit, then you take stock of what's going on a daily change basis, and the average rate of change here thus far in 2023 in a good sense is clearly below what it was last year. I mean, we had pockets of really intense volatility where we had like major changes on a day-to-day basis. But what's important to know is even though it feels like maybe things have settled down, we actually have daily volatility that's higher than this long-term average since 1957. You look at earnings growth out of the fourth quarter, and so we're essentially done with the fourth quarter earnings now, with some exceptions. There are a lot of retailers that tend to report really late and whatnot, but for the most part, we've got all of this stuff in the bag now, and you can see where energy, industrials, real estate were really the drivers of the cycle, and then you had consumer discretionary, you had materials and communication services that were down quite a bit. Now, where the evidence shows is that, a lot of, say, the areas like energy industrials, the actual results were below the estimates as they stood on December 31st. So earnings weren't as robust in those areas as people thought. And in the cases of the areas of the market that were down, that those earnings turned out to be a little bit worse than they were expected to be at the end of last year. And we'll see that this is really the kind of the risk, the fly in the ointment, if you will, on this whole discussion of where do equities go. Are we on the precipice of an earnings recession? Maybe. And if that happens, then the E in the price to earnings ratio goes down, and so it kind of pushes those multiples higher. And generally, when you have sticky higher inflation than trend, it doesn't foreshadow a large breakout in equities, even though the data says that after you get past the rate tightening peak, that stocks tend to perform pretty well. It's got this nip and tuck here, right? This battle that's going to be played out between these various factors and trends that I think could result in kind of a trading range for equities over the last half and the last 9 months of this year. Here we have S&P profit margins, and we know that those have been challenged and those have kind of eked down. Again, this is representative of the inflation, of the cost input factors on the part of S&P 500. This is data from BCA Research, so group out of Montreal. Very good work that they do, and they've been around a long time. So, this is data that we have to take into stock when we think about earnings recession, when we think about directionally where does the S&P 500 go over the rest of this year. Here's bottom up earnings per share. So this is like taking the composite earnings, adding all of the earnings from each of the S&P 500 constituent firms together. And so what you have is the 2023 bottom up earnings number at the bottom of this chart. That's the lower line. And you can see, going back to maybe a little fuzzy because I had to blow this chart up, back to roughly the same time last year. And you can see where, over the ensuing few months, estimates went up, but then they've tracked down, ever since then. And so, you see that the estimates for 2023 clearly have come down and they're kind of at their lowest point here. And then the dotted line, the upper line represents the bottom up estimate for 2024. And so earnings are expected to be higher next year than they are expected to be this year. And so, but those estimates have come down. And so, where we stand now is that basically 2024 S&P 500 estimates are about where we thought 23 was going to be at the end of May. So here we have multifamily construction at a really high point. I mean, we haven't seen this since 1973. We have a lot of apartments being built, ostensibly in major markets to help, resolve or address some of the affordability issues. But really interesting to see, when you look at this as an investor class, I mean, the multifamily residential is actually, more of a, viewed more as a, commercial investment, if you will, and it falls in those kind of industrial and commercial real estate investment zones as opposed to the residential, which should be more like 1 and 2 family condos, single family, those types of things. But this is a parabolic move in multifamily. It's pretty impressive. So homes bought by investors. So, when you think about, a lot of the speculative drive behind rising home prices after the pandemic, a lot of it had to do with investors. And you can see over time that, after the global financial crisis, which really took a hit on prices, and you had that major reset, that you had a lot of liquidity driven by basically 0% short-term interest rates. Low interest rates in general created this environment of very easy money, and so it was easy to get money to buy homes on an investment basis. Again, these are homes that you don't live in, that you own, you rent, or whatever. And so at various points over the last 15 years, we've seen really strong spikes in investor interest in residential dwellings, and we certainly did after the pandemic. But now we see on a year-over-year basis that has really decelerated. In fact, we've had a clearing out of investors, and so we've taken that whole segment of the house buying market really out of the market. And so that has had a lot to do with home prices moderating and going down. And obviously we know with interest rates increasing, that the cost of credit for people to buy these homes on speculation has obviously increased, and so that also helps to drive this investor demand down. And I think it's going to remain low for a while because, again, we have sticky inflation, which means that we're going to have sticky interest rates that are going to be higher than they have been, and I think that's going to lead to a healthy normalization in the real estate, in the residential real estate market, and it's going to keep these investor numbers subdued for a period of time. Well, here we have the Zillow Rent Index. I foreshadowed this previously. We've had 4 straight months of rent deceleration in the market after a fairly strong rise. And of course, rents follow home prices, and so we've clearly seen that. But now home prices, have been down, and we've been talking about that for a number of months now. And so rents have kind of followed in tandem with that. And so now rents are not down nearly as much as they had been over the last couple of months, but still they're negative by 0.06% here. Now we'll end on a couple of kind of like general interest charts, and one of them is more secular in nature, and it's this one: the number of births per 1,000 people in China. I mean, we've talked about the secular demographic trends in China are entirely unfavorable, and not that they're extremely favorable in Japan, Europe, and the U.S. either, but China is in a really a deep pickle when it comes to worker replacement, and how are you going to grow your economy if you have a shrinking population? And that's exactly where China is right now. And this is a chart that kind of, I think, sums it all up. And finally, we have a chart that I think we're going to be paying a lot more attention to AI, and as it relates to process management, process design. I think of AI entering in the financial industry and having a potentially profound impact. Had a kind of a breakfast conversation with somebody who's doing a lot of work in trying to automate administrative processes within the financial sector. And you can see here that over the last several years that there has been a really large spike in corporate investment in artificial intelligence on a global scale. And I think this number is apt to look rather geometric or accelerate in the years to come. That's all we have for this week. I hope you've enjoyed the charts and chat. Love to hear from you. Have a great week, and we'll talk to you again soon. Take care. Bye-bye.